I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear, fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow a dollar and spend a dollar, you don't even get a dollar's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider, something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while.
According to Jim Rickards, there is a growing concern that both the Federal Reserve's monetary policy and Congress's fiscal policy are failing or will fail. He dismisses the idea that deficit spending and money printing can stimulate the economy and claims that the Keynesian multiplier is now below 1, meaning that borrowing and spending a dollar results in less than a dollar's worth of GDP. He also disagrees with monetarists, new Keynesians, and Austrians who believe that money printing is linked to inflation. Rickards suggests that gold serves as a reference point for monetary value and that its price reflects the market's anticipation of future events. He argues that a rise in gold prices could be a signal that markets are anticipating a significant change in the economic landscape. However, he acknowledges that predicting the future is difficult, and even markets are not very good at it. He notes that markets try to anticipate future events and discount them accordingly, but they are consistently wrong in their forecasts, creating a gap between perception and reality. Nonetheless, Rickards believes that reality will eventually prevail, even if it takes time.
Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's, well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. And there's a number of different techniques. And what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long-range forecast. But, it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One that you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all, and I follow them all. But they've all been carried out feet first on this, bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting.
Gold has a high predictive analytic value and is more forward-looking than other indicators. It serves as a signal for where things may be heading in the economy, perhaps a year or 18 months from now. Rickards believes that gold is indicating that both monetary and fiscal policies will fail, and something else will be attempted. As a result, the price of gold will rise significantly. In fact, Rickards has a conservative forecast of gold reaching $15,000 per ounce by 2025. Rickards is confident in his long-range forecast, even though the price of gold may fluctuate day to day. He doesn't get depressed when it goes down or euphoric when it goes up, as he knows where it's going in the long run. Gold serves as a means of preserving wealth over time, and risk aversion is a higher priority than just making money in the short run. Rickards highlights that there are three fundamental drivers of the price of gold: real interest rates, supply and demand, and geopolitical risk. Real interest rates have a significant impact on the price of gold, with lower rates leading to higher gold prices. Supply and demand is also a significant factor, and geopolitical risk, such as political instability or tensions between countries, can increase the demand for gold as a safe haven asset. Currently, all three fundamental drivers of the price of gold are pointing in the same direction, indicating that the price of gold is likely to rise. Real interest rates are coming down, and geopolitical risk is high, while supply and demand remain strong. Despite the concerns of some analysts about the bond bubble and the inevitability of interest rates going up, Rickards points out that real interest rates are not low, and that a negative real rate of 4% would indicate a lower rate. Therefore, Rickards believes that gold is a reliable indicator of where the economy is headed, and that it's important to pay attention to its signals.
It's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, and a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing kind of a spike in gold prices when real rates are still relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say, if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold. $1,000.
The current state of interest rates, inflation, and their impact on the economy is concerning. Despite interest rates being low, inflation is still high, resulting in a negative real rate. However, Rickards compares the current situation to the 1980s, where inflation was much higher than it is now, resulting in even lower real rates. Rickards also suggests that negative interest rates are possible, but not necessarily something that the Federal Reserve wants to pursue. Rickards also mentions the concept of negative yields to maturity, which can occur in secondary market trading regardless of what the Federal Reserve does. Rickards predicts that there will be huge capital gains in 10-year notes as the yield of maturity approaches negative 1%, which will be a boost for gold. Rickards then shifts his focus to inflation and argues that printing money does not cause inflation, but velocity does. Velocity refers to the turnover of money, lending, and spending, and it is a psychological phenomenon that is difficult to control. Rickards suggests that the current psychology is deflationary, with a high savings rate and a focus on consumption rather than investment. To change this psychology, Rickards proposes a $5,000 price for gold as a solution. He believes that this would be a dramatic event that could make people take notice and potentially shift their focus towards investment and away from consumption. Overall, Rickards' analysis suggests that the current economic situation is complex and multifaceted, with various factors at play that will require creative solutions to address.